Ever wondered how you could potentially reduce the impact of market volatility on your investment portfolio? Today, we're diving into an investment strategy that has proven its mettle time and again in managing risk and possibly enhancing returns over time. This strategy is none other than dollar-cost averaging. Often overlooked, dollar-cost averaging is a simple yet powerful tool in the investor's arsenal. So gear up, folks. Keep watching to find out how dollar-cost averaging works and how it could benefit you. So, what exactly is dollar-cost averaging? Dollar-cost averaging, often abbreviated as DCA, is a strategy used by many investors worldwide. It's not a get-rich-quick scheme, nor is it a complex financial maneuver reserved for Wall Street veterans. On the contrary, it's a straightforward, disciplined approach to investing that can be adopted by anyone, regardless of their financial acumen. At its core, dollar-cost averaging involves investing a fixed amount of money into a particular investment, such as a stock or mutual fund, at regular intervals. This could be weekly, monthly, quarterly, or any time frame that suits your financial situation and investment goals. The crucial aspect here is consistency. You invest the same amount of money each time, regardless of the price of the shares at that moment. Now, you may be wondering, why would I want to buy shares when the prices are high? Well, that's where the beauty of dollar-cost averaging comes into play. When you invest a fixed amount regularly, you end up buying more shares when the prices are low and fewer shares when the prices are high. Over time, this can result in an average cost per share that's lower than the market average. Think of it as a form of financial discipline. It's like setting your alarm clock to wake up at the same time every day. Sure, some days you might prefer to sleep in, but maintaining a regular wake-up time can help regulate your body's internal clock and improve your overall sleep quality. Similarly, dollar-cost averaging promotes investment discipline, encouraging you to stick to your investment plan regardless of market conditions. But why is this discipline important? Well, the stock market can be a roller coaster ride. Prices rise and fall, often unpredictably. By investing a fixed amount regularly, you mitigate the impact of these market fluctuations. You avoid the pitfalls of trying to time the market, which even seasoned investors struggle with. In essence, dollar-cost averaging is a disciplined approach to investing, designed to mitigate the impact of market fluctuations. It's a strategy that promotes consistency, reduces risk, and over time, can result in a more favorable average cost per share. Now that you know what dollar-cost averaging is, how does it work in practice? Let's take a hypothetical situation here. Imagine you've decided to invest $100 into a mutual fund every month for a year. The price of one share varies each month. Sometimes it's high, sometimes it's low. The key here is that you're investing the same amount of money regardless of the price. You're buying more shares when the price is low and fewer when the price is high. This is where the magic of dollar-cost averaging comes into play. By buying more shares at a lower price and fewer at a higher price, you're effectively lowering your average cost per share over time. Now let's break it down further. In January, the share price might be $10, so your $100 buys you 10 shares. In February, the price drops to $5. Now your $100 buys you 20 shares. By March, the price rises to $20. Your $100 now gets you only 5 shares. If you add all the shares you've bought, you have 35 shares at an average cost of about $8.57 per share. However, if you were to calculate the average market price over these 3 months, it would be close to $11.67 per share. You can see that the average cost per share using dollar-cost averaging is lower than the average market price. This is the potential benefit. If the price of the shares increases in the future, you could stand to gain higher returns because your average cost was lower. Remember, dollar-cost averaging is not about trying to outsmart the market or predict its movements. It's about maintaining a consistent investment strategy, regardless of market conditions. It's about discipline and patience. It's about letting time work its magic. By investing consistently over time, you're not trying to time the market, but instead time is working for you. So, why should you consider dollar-cost averaging? Well, let's recap some of the key takeaways about this intriguing investment strategy. First off, dollar-cost averaging, or DCA, is a simple and disciplined approach. It doesn't require you to be a Wall Street wizard or have a crystal ball to predict market movements. All it requires is a regular investment of the same amount of money, regardless of market conditions. This strategy helps manage risk, especially in volatile markets. Instead of trying to guess when prices are low or high, you're spreading your investments over time. This can help smooth out the peaks and valleys of market swings and reduce the impact of buying high. Now, here's where it gets interesting. DCA can potentially lower the average cost per share of your investments. How, you ask? Well, when prices are low, your fixed investment buys more shares. And when prices are high, it buys fewer. Over time, this can result in a lower average cost per share compared to making a lump sum investment at a single point in time. But remember, DCA is not a one-size-fits-all strategy. It's particularly suitable for long-term investors who are comfortable with market fluctuations. If you're the type who gets jitters every time the market dips, or if you're looking for quick returns, then this might not be the strategy for you. DCA also doesn't guarantee profits or protect against loss in declining markets. It's a strategy that plays the long game, focusing on potential gains over a longer period. And like all investment strategies, it should be used as part of a diversified portfolio and tailored to your personal financial goals and risk tolerance. In conclusion, dollar-cost averaging is a methodical approach to investing. It's about consistency, discipline, and a long-term perspective. It's about making market volatility work for you, not against you. Remember, investing is not about timing the market, but time in the market. Dollar-cost averaging is a tool that can help you achieve this. So there you have it. Dollar-cost averaging in a nutshell. We've unraveled its concept, walked through its mechanics, and highlighted the key takeaways. It's a strategy that can potentially smooth out the peaks and valleys of market volatility. But remember, it's essential to evaluate whether this aligns with your investment goals and risk tolerance. As always, make sure to consult with a financial advisor before making any investment decisions. Until next time, stay financially savvy.